Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters & Associates, a financial services firm here to help business owners navigate the decisions they face every day.
As we approach the end of the calendar year, we naturally start looking ahead and asking questions about what the next year will hold. That is 2026, not only in our personal and business lives, but for the economy, the markets, and the world.
Are you asking my opinion?
Well, not really. Instead, I thought we might lean on the opinions of some more respected economists, maybe.
Well, that hurts, but I'm going to tell you what I think anyway. So let's go.
Well, listeners, we started before we recorded. We're going to timestamp ourselves. December 4th today. We started and said that we're officially going to be professional today.
Yep.
It's gonna be very professional.
Especially me.
Yeah. If you're watching on YouTube, you see how professional we look.
You look very nice today.
Thank you. I presented Judson with his Christmas present. It's a candy cane from Target, stuffed with Haribo gummy bears.
That's where it was great.
Yeah, it was great. I'm here for that. I had to take out a Klarna.
Well, I'm glad you're paying later, though.
Yeah, it's exactly right. It's a good financial plan decision. Well, I thought, as we opened up, we should go over just a little bit. This is going to be market focused mainly today, folks. But November was a fascinating month in the markets. And so, Judson, I thought it'd be good to cover that. And then we have some prognostications, or I should say some top risks that Apollo's throwing out there. So we're going to run through those for 2026. So that'd be fun.
It will be fun.
November was crazy because, Judson, the S&P was up 0.3. That's it. It's a very boring month, right?
Yeah, so it was just exactly flat every day.
Yeah,
except for a couple of days that were barely up.
0.15%.
No real movement.
No movement whatsoever. Well, yeah, so it's up 0.3. Global stocks were only up 0.1. And you look at that, listeners, and you're like, oh, that's a boring month. There's nothing going on. In reality, I was looking at these numbers for our investment recording, which, by the way, listeners, you can find at the end of each month on YouTube, on our YouTube channel. But before I jumped on there, so the month saw swings of down 3, up 3.5, down 4, up 5.5 to finish at 0.3.
Days.
Swings over like a couple of day period. Yeah. And of course, crypto got blown up. And a lot of other things happened to make it sort of an ugly month. Sort of the interesting thing about the month, though, is S&P was up 0.3, but S&P equal weight, which all that means, listeners, as a reminder, is if instead of it being market cap weighted, if you gave every stock its equal weighting, was up 1.9, damn near 2%.
Interesting.
Small caps are up 3%. So when you look at the construction of the S&P and you say, okay, well, it was only up 0.3, but equal weight's up 1.7, what that means is that the heavier names, right, the Mag 7 names were way down for the month. That drug the index down, but broadly, the index was actually up. There was a lot more, let's just say the market is starting to get some breadth to it, which is, we need a lot more of. Yeah, it's a good thing. And then again, when we go down to small caps and see them up 3% for the month, that breadth that narrative continues to hold true.
Which we talked about months ago when interest rates started falling, that, we would think that eventually that small and mid cap stocks would respond to that. And we're probably seeing some of that.
Yeah. Yeah, I think, a natural rotation is certainly in the cards. But in the sort of intra-month period, you look at it and you're like, oh, man, there's some ugly times, especially when crypto's getting blown up and NVIDIA reports earnings that are actually pretty good, but it still goes down. You start to have some questions about the health that's sort of going on there. So that brought up sort of this interesting stat that we're going to go through.
It is an interesting stat. You know what? Even right above it, it says interesting stat.
On markets. It's bolded. I didn't even put that either. I don't even know where that came from.
Somebody wrote that and was like, this is interesting.
This is an interesting stat on the markets. All right. You want to do these numbers?
Yeah. Okay. So what this basically is talking about is during any given year, how many times we see a certain percentage drop, right? So starting with 1%. 1% is not that big of a drop. But we see a 1% drop 50 to 60 times in any given year, right?
So basically once a week.
Basically once a week, right? 3% drop, much larger, 3 times to be exact, happens 7 to 8 times a year. Okay. 5% drop.
3% drop happened twice in November.
In November.
Yeah.
Right. 5% drop happens basically quarterly, 3 to 4 times a year. And a 10% drop doesn't even happen once a year, just over once a year, every 1.1 years. 15% drop every 2 years, 20% drop, 20% drop every 3.5 years. How long's it been?
2022.
Two?
Yeah.
Yeah.
Yeah. So, and again, if you do that, that really, if you look at 22, 20,
Yeah.
18, we saw it in certain pockets. So, I mean, that checks out for sure.
And then the 25% drop every 5 to 7.
Which kind of happened in 22, but you had to be in the NASDAQ there because the S&P didn't drop
It
25.
definitely happened in 20.
Yeah, it definitely happened in 20 though. Yeah, which, I mean, again, that all of those statistics would bode for probably something in 26.
Yep.
Now, again, we're not saying that, listeners, by any stretch, but I think the sort of narrative here is that these big swings happen more than people probably realize.
But this also doesn't mean that the stock market's down for the year. I mean, 2020 is a great example. We don't want to go through that again, but it was down significantly and then ended up positive for the year.
Yeah.
So this is intra year.
They don't
right?
all end up like 22.
Yeah.
That's a great point. So it actually also this fascinating stat that I saw that I wanted to bring in. I mean, because again, our takeaway with this, listeners, is when these 1, 3, 5% drops occur, you just kind of keep going. In fact, maybe those are opportunities, during the month of November to maybe buy off one of those bottoms, and you're in a really good spot as things rise back up. But I read this interesting stat about Roger Federer.
Okay.
Yeah, I'm bringing some tennis in.
Good.
You just gave me the look like Hunter's going to be a dork and going to bring up something from Bloomberg.
No.
Yes, you did.
No. I just am amazed at how many interesting stats you have today.
I feel judged by you.
It's fine.
Whatever. I saw this the other day and I was like, oh, that applies to investing. Okay, so here's the thing. Judson, Roger Federer, he's a good tennis player.
He is.
Did you know he played tennis?
Yes, I do.
Okay. You know what country he's from?
Big tennis fan.
You're a huge tennis guy.
Yes, I am. He's from France. French,
Okay.
Bulgaria.
Oh my gosh. Okay, so Roger Federer, here's the fascinating thing. The dude, it was crazy. He won 1,500 singles matches in his career.
Okay.
He won almost 80% of singles matches he ever played. 20 Grand Slams, 103 titles. Do you know how many points he won? What percentage of points he won? So he won 80% of all of his matches. He's probably the greatest tennis player of all time. How many individual points did he win?
What percentage of the total?
Yep.
54.
54 on the dot. Give me a fist
Is it
bump,
really?
dude. Heck yeah. That's
Big tennis fan.
badass.
Big tennis
Huge
fan.
French Bulgarian. Okay.
It's like golf, tennis.
So you were following me though, right? Like 54. So he's basically a coin flip on individual points. And of course he had to win more than he lost or else he wouldn't have won 80% of his matches. Basically a coin flip, yet still he's the greatest of all time. Right? And it's the same thing. It's the Buffett idea. It's all these things we've talked about with the S&P 500 is up 3 out of 4 years, but it's a coin flip on a day-to-day basis, right? And so we always bring it back to that, and it's cool to see that that doesn't just happen. You don't have to just talk about the markets with that. You can also talk about that more broadly in sports statistics. But I thought that was a really great way to sort of frame like what we do when we have months like November. We just keep powering through.
Agree.
So, now, listeners, we will do we'll probably have Brad Sanders on because why not? He's like a regular now. We'll do a full 2025 market recording at the end of the year. But ahead of the end of the year.
Or at the beginning of next.
Sure. Maybe we'll do it before the end of the year and just guess.
Yeah.
It'd be
that's
great.
what I'm thinking. Like the
It'd be
next
great.
3 days. We'll do it on the 27th. We'll do it on Christmas.
Yeah. What else are we doing?
Yeah.
We probably we got to go over predictions anyway because I was right on all of them.
Yeah. Totally.
Especially the college football playoff. I was dead on all this. But that being said, we thought today it would be good. There was an email bright and early this morning from Apollo, their chief economist, on his top 5 risks in 2026. Now, these are not top 5 things that are going to happen. They are the top 5 risks to the macro global economy in 26 that they quote. What does he say? They are the 5 things they are watching. Okay. So we're going to play a little game.
And they're great talking points.
They're great. Yeah. Judson's going to read one. I'm going to answer what it kind of means, and then I'm going to read one, so on and so forth. All right.
Go. Top 5 risk number 1. The U.S. economy starts reaccelerating because of the fading trade war shock and the one big, beautiful bill, and inflation begins to move higher from an already high level.
Yeah, so I think on this one, the theme that you're going to see running through these is the fear of inflation, right? Because the Fed is going through some rate cuts because they're trying to, really control, sort of where things are going and keep inflation under control. They're aiming to get it to like a 2.1 to 2.2. It's sitting still at 3. And so this point that they're saying is that the economy starts to reaccelerate, meaning it starts to grow. And they kind of give two reasons why: fading trade war shock, and then the one big beautiful bill, which we've talked about that the one big beautiful bill on here, Judson, and how because of all the bonus depreciation in there, because of all the individual tax benefits, we're going to have a record refund season. So probably the most tax refunds in the history of the U.S. economy are going to occur in April. And we've said that before on here because it's an opportunity for our business owners to take advantage of people having money in their pockets.
What do people do when they get a refund? They put it into savings?
They definitely put it in a Roth IRA.
That's right.
That's the first thing they do, and pay down debt.
Because they listen to this podcast.
That's right. Financial Literacy 101. They go spend it, right? And so his point here when he's saying this is a risk is that with all of those impacts and people having more money and businesses having more money because they're bonus depreciating things, the fear would be that things start to reaccelerate after the Fed is cut a handful of times and we get hyperinflation again, or some sort of other sort of bull run in the economy, which could certainly create a problem in the stock market. Just because the economy rips doesn't mean that the stock market rips. Essentially, what would happen there is the economy would rip. Everybody would say, "Oh no, the Fed's going to stop cutting rates or increase rates," and the market would probably take a nosedive.
But I think, to your point, and this is kind of what one of the things I wrote down is for many of our listeners who are small business owners, a big refund season is very helpful for consumerism, and so is the no tax on overtime pay and the no tax on tips, because this is how many of your patients are making money.
Exactly. So take advantage of it, but it could be a potential systemic risk to the stock market, I think is the point here. Okay. Number 2, Judson, coming to you. The global industrial renaissance, which we've talked about on here, right? So this sort of renaissance of industrial development across the globe boosts global growth with more and more countries focusing on home shoring, advanced manufacturing capacity, investing in infrastructure, energy, defense, and supply chains. Judson, why would that be a risk in 2026?
Well, I think that it can be, but it can be both a positive and a negative risk. So one stat I found that was pretty interesting is the capital demands for utilities, digital infrastructure, and energy transition in 2026 is somewhere between $75 and $100 trillion. Okay. So, and we've talked about this again on the podcast before. There's tons of money being invested in this, tons of money. Okay. In the U.S. alone, there have been 200 factory completions since 2023. So this actually, again, when we go back to like the last election cycle, good Lord, this was something that both sides were talking about: nearshoring, onshoring, bringing, industrial back to the United States, all of this kind of stuff, and it's happening. So, I mean, I think the investment, right, spending money is good for economic growth, and then I think that hopefully on the positive side, you have with factory completions, you hope that increases job demand as well. Right. And that's really what we want inside the United States. And part of the big reason for doing this.
Yeah. I mean, we stood on stage in last year at our annual meeting in Vegas and talked about this industrial renaissance. Like we said, hey, this is coming. And now it's showing that it's coming.
That's right.
And I think one of the things, I agree with everything you said. I think one of the things that he's saying is a risk here is that because ultimately that would lead to GDP growth, which is good. That's a good thing. But at the same time, that could create some quirkiness in the stock market, right? That's the biggest thing here, right? Is like, what are the implications on the market if all of a sudden that rip happens and, all of a sudden it causes inflation to soar, and now we've got Fed issues as well.
This also could be a contributor in risk number 5, which you're going to talk about.
Exactly. Yeah. But before we do that, let's do 3.
Okay. Risk number 3, the new Fed chair lowers interest rates purely for political reasons.
No,
never could happen.
That would never happen. No. I don't even know that we need to say anything. I think that was it's out there. No, I mean, like the reality is that the Fed, as we've mentioned about 150 times on this podcast, is supposed to be apolitical and agnostic. I think the risk here would be that potentially the administration would try to persuade, given that President Trump has already said he believes in decreasing rates to boost growth, that the president might persuade the Fed chair to do so.
Well, you can also probably restate this and just say the Fed lowers interest rates too early.
Exactly.
Right?
Yeah. Yeah. I mean, I think, look, that is a huge issue in 26. If the Fed goes too fast on this and inflation reaccelerates, which again is sort of thematically in points 1, 2, and 3, if the Fed does that and inflation reaccelerates, now all of a sudden you're getting into a situation where the Fed is going to have to change some of their wording in their minutes, which everybody looks at, even if they don't cut rates or if they don't change rate forecast. If they change the wording in their minutes, people start to their ears perk up, or heaven forbid they increase rates, and the market will absolutely hate that.
Yep.
Yeah, it will absolutely hate that. And so again, that kind of goes hand in hand with what we talked about, that we're probably due for some sort of larger correction in 2026. Hopefully that doesn't happen. But if the Fed went too fast, to your point, it certainly could.
Well, and you talk about the inflation side of it, but if they lower rates too fast, there could be over borrowing again, going to number 5, but also from the consumer standpoint, which can worsen some bubbles that may or may not be out there that we're going to talk about in number 4.
Yeah, I mean, look, I think we saw what happens when you artificially have rates too low. You don't get out in front of inflation or whatever else it is, and you get a market that creates huge frothy bubbles. We saw that with crypto. We saw that with NFTs. We saw that with all kinds of things in 2020 and 2021. And you get the result in 22, which nobody wants to go through again.
Producer Aaron, can you name this episode Frothy Bubbles, please?
Frothy bubbles.
Okay.
It should be that way. Okay, 4. I'm reading this one to you.
Yeah,
right?
you are.
All right. Number 4, AI bubble. AI bubble bursting results in a major correction of Mag 7 equity prices and slows CapEx spending and high-end consumer spending. Judson, there is a lot here.
There's a lot here. And again, we've talked about this multiple times. We mentioned it in the second risk that we talked about, right? There is tons and tons and tons of money going not only into capital investments related to AI and energy, but tons of investors' money into specifically, it's talking here about the Mag 7 and investing in those companies, and they're at record sizes. They're huge companies, and I think what they're talking about here is that if that AI bubble burst, it's not that we think we're necessarily surprised if we see some of these companies not grow as much, like you're talking about in November, right? The S&P 500 equal weighting was up while the S&P 500 index was down, which specifically talks about this technology piece, this Mag 7 piece, not doing as well in November. What it's talking about here, bursting, is going to go a lot farther than just a smaller 1 month. Oh, look, there are other stocks outperforming these Mag 7. That could go towards, a lot of people obviously losing quite a bit of money in their investment accounts because they may be over allocated. And then because of that, it immediately goes towards high-end consumer spending, because if that segment of the market really busts, who's it really probably affecting the most? It's affecting the accounts of people that have been investing it and maybe over-investing in it for quite a while.
The Ferrari drivers.
Yeah,
indeed. Yeah, I mean, look, I think at the end of the day, the reason Mag 7 is ripped so hard is because of all the AI CapEx, because investors are, well, and also because of passive flows into index funds, but because investors are, optimistic about what the Metas and the Googles and the Teslas and the NVIDIAs can do with all this CapEx. And as a result of that, if that does burst, absolutely, it's going to have huge ramifications on Mag 7 prices, which will drag the entire index. I mean, all the other stuff can do fine, but that index is going to get obliterated. Yeah. And that's because it's damn near 50% of the index at this point. So interesting thing to watch. I think, hopefully the CEOs of those Mag 7 slowly dial things back and don't just have some sort of notice in their earnings where it's like, hey, we're going to stop spending right now, because that would be a bloodbath in the markets.
Yep.
All right. Let's do
Okay,
5.
and finally, number 5.
If you haven't fallen asleep yet, wait for him to read this one, everybody.
You ready? Dramatic
Dramatic
increase
Dun,
in
dun,
the
dun.
supply of fixed income in 2026, coming from growing government deficits and hyperscaler issuance, puts upward pressure on rates and credit spreads.
How we doing, listeners? There were a lot of words in there.
It said hyperscaler. I think I had a hyperscaler shirt when I was in junior high.
Yeah. So let's go through our junior high. So you had Z Cavarici.
Yeah, some Z Cavarici
We had
jean jorts.
Jabos.
Yeah.
Jabos. The French. Hey, that was French Bulgarian.
Yeah.
Jabos.
Hypercolor shirt.
Stassi.
Yeah.
Stassi shirt that had like the.
Sissy.
I don't know, but it had this. It was sissy.
Yeah.
But it had
And-
like 6 cents in it.
That's come back for
It
the
has.
kids. There's like a big store in New York that's back.
Carrie and I went to this like upscale vintage like thrift fair when we were up in Fayetteville visiting Ronnie. And yeah, the whole racks were all these like 100% cotton Stussy shirts.
Yeah.
And they were like $28. I'm like, babe, we should have just kept all this stuff.
In the 80s, we wore jams.
Be millionaires. Wow, we got off track. Okay. What this is saying, listeners, is if you think about this for a second, if government deficits, essentially, if government deficits grow, they're going to have to increase the supply of their bonds. Okay. And it's the exact same way for corporations as well. And if they increase the supply of bonds that are outstanding, let's just do a simple supply and demand for a second. If there's more bonds available that have been issued to raise money for governments and corporations, if there are more bonds available to raise money and the demand stays the same, what's going to happen is it's going to they're going to have to force the rates up to be able to get people to buy their bonds. That's what this is saying. And again, it sort of goes right in line with all these other things. It's sort of this like global systemic, like what happens if this whole machine stops, right? If inflation rips or AI CapEx stops, whatever else it is, it won't just affect, I actually love that he includes, it won't just affect equities, period. It's
100%.
going to affect fixed income as well. And I think sometimes we think that, our fixed income accounts are a safe haven or whatever else it is. And they can and they should be. And there's going to be times where they're going to be great. But this could certainly create a problem in the fixed income markets as well.
Yeah.
Now, what I will say is, look, at the end of the day, we're not prognosticating these things are going to happen. These are just potential risks that are out there. Judson and I fully remain bullish on, the global economy and where things are going. There's so many cool things that are coming with robotics and AI. Do we feel like there will be an opportunity where things will, remain volatile? Of course. That's why we started with the stats on November. And that's why we started with the idea of the Roger Federer, which is like, hey, look, if we're winning every other day, right? 54 out of 46 days, and we just do it, systematically in our portfolios, we're going to be fine. And that, I think, is the best thing we can do as we head into 2026, is just remember that no matter what happens in 26, that as long as the global economy continues to be strong long-term and we've got really good direction of where things are going, we're all going to be fine in our financial plans.
Yeah, and I think also a reminder that, how much risk you feel comfortable with is a personal decision and discussion for each individual client. And I think that there's clearly risk in being over risked, but in our financial plans, there's also risk of being under risked, right? So, I think that's what we really help our confidence do is to get a confident plan that fits your risk profile, but also fits your long-term goals. So, if you have any questions about that, if you have any concerns about your own portfolio from a risk standpoint, that's what we do.
That's right. And I will do one more plug. We are filling up on the annual meeting in Nashville, but there are still a couple spots left. And in Nashville, I will actually be on stage talking about what can we take from the past, right? Like these past, whether it's the agrarian revolution, railroads coming in, the digital revolution, consumer revolution. What can we take from these previous ones as we look at this AI revolution and what it means for our future? Because we can't necessarily guess what it's going to mean, but we can take some things from the past and learn on how we should look at the future. So please come see us in Nashville. we would love to spend 3 days with you. But I think it's a great opportunity for learning as well.
And if you do come to Nashville, I will also be on stage, mainly talking about lunch and potty breaks. The best way to keep up with this is to hit subscribe. You'll never miss an episode, and you can always go back and catch up with the ones you've missed. If you're enjoying the show, leave us a review. We really do want to hear what you think. Got a question, comment, or even an idea for a future episode? Reach out at kanewaters.com/wealth. We read them, and yes, we actually reply. And if you want to learn more about what we do and we're not behind the mic, visit kanewaters.com, where we're helping more than 3,400 clients work towards their long-term financial goals. Thanks for listening to the Accumulating Wealth Podcast. We'll see you next time.
Nobody talks about potty breaks better than you.
I know. That's why I do it every year.